Hey everyone, welcome to the show. So we want to become, and I'm your host Kushana Nathan. Today we have with us Mr. Arun, senior leader in India's financial markets and the current head for bank balance sheet management for Kotak Mahindra Bank. Over the course of his career, he has worked across fixed income, foreign exchange, and derivative markets. So thank you for joining us today. It's a pleasure to
Yeah.
have you here. And before we get into all those roles, those titles, to put it pretty simply, what is finance? I mean, it's too broad a term, but what is finance and what are those markets that we refer to throughout this?
Finance by definition is about money. So that the most basic definition of finance. So in any economy, there are people who have money and there are people who need money. The financial services industry is basically how the money is taken from the people who have it and given to the people who need it. Simple. Who are the people who have money? People like anybody who's saving money, anybody who is earning a salary, any company who has profits, who has surplus, and any government which collect taxes, which sitting on saving. Everybody has money. Who need money? Again, companies who are building a business. If I'm buying a house, I need money. If I'm going for a foreign education, I need money. So everybody needs money in some form or the other. So it's about how you move the money from people who have it to who need it. When you say financial markets, now this money the saver gives to the people who need it, obviously they don't give it free. There's a price to it, right? They are going to ask for a price. And financial markets, what is a market? A market is a place where there's a buyer and a seller and where they agree on a price, right? What in economics we call price discovery happens. You'll say, I'll give it to you for 100. You'll say, no, I'll want for 50. And then that's called price discovery. A financial market is where the price discovery of this movement of money from savers to borrowers happen. Simple terms. There are many kinds of forms in which this money moves. So those are the different kinds of financial markets, and so each of them have their own role to play.
So, okay, so when did you realize that finance and markets were your calling?
Okay, I need to mm, step back a bit from school where we studied, and during those times, the natural thing for anybody to do, at least those who got good marks, was to get into engineering. Otherwise, you are considered nobody. So by default, I went to engineering, and then I got into IIT, so which is supposed to be the best place for engineering. I'm not sure where it changed, but somewhere in the final year, I started moving more into courses like operations management and systems and industrial engineering, which is less of hardcore engineering, more of management of engineering process. So from there, I then went on to do my. So I decided, okay, let's move to an MBA, not get into proper engineering, or maybe engineering is not my calling. So when I went into MBA, I discovered an entire new world, which is world of economics and finance. And I loved economics, basically, especially macroeconomics, which was what finance is all about, micro and macro both. But the world I'm in is more of macroeconomics. So I love macroeconomics. Finance also requires you to be good with numbers. And especially when you are in markets, you are required to be very good and very fast with numbers, which was, I was sort of my strength. So that was my naturally, I veered towards it. Another interesting thing that happened is this was around 91, 92 time. You guys may not be knowing there was a big scandal that broke out that time called the Harshad Mehta scandal, which
Yeah.
there was a Sony series about it. You can go and see that. So that scam made news. But more importantly, that scam opened up an entire new world for most of us about the entire what is happening in the, especially on the interest rate market, equity market. So it was very fascinating to read about all that. So that sort of pushed me in that direction.
So were there any like moments or let's say early mistakes that like pushed you to like how you approach your career later?
Uh,
Apart from engineering, of course.
yeah, that's fine. So what I won't call mistake. It was a lot of learning. First of all, finance tends to attract a lot of very brilliant people. So you need to be very good at. You need to be able to sell yourself better. I was not very good at that initially. Ability to sell my ideas to anybody. So that's something I learned. I learned as I went along. So you have to market your ideas, you have to market yourself. So that was one of the biggest learnings along the way. And at the same time, you are selling something complex to people who may not be so well aware. So keep it simple while trying to explain a complex subject, which is what I also learned how to do.
To me, when I ask you about all those equities or fixed income or forex or I can keep going with terms, but it all seems very overwhelming to me. But how did you overcome that? I'm pretty sure you also got overwhelmed in the first place.
Yeah, I guess when you start getting into finance in your MBA, you realize the various terms and you become very familiar with them. But that only gives you the basic grounding. So nothing like jumping into the job and then you're on your own. You slowly figure out things yourself. Other point is, see, equities, fixed income, and FX are, well, they're all used very broadly. Each of them are actually individual markets. So you go into any one of them and then you keep moving around here and there. So that's something you decide as you go along. You figure out that each of them has their own specialization. And so it's not as if you learn everything. For example, I don't know anything about investment banking, which is a very different area. I don't know anything about accounting. I've been an out and out markets guy. I'm not even an equities guy. While I understand a little bit of equity markets, ability to understand deeper into company equity research is a different skill set. So I don't know that. So you get into an area of specialization in finance and then you move on.
How do you explain fixed income, foreign exchange, and derivatives to a student with, well, like me, no finance background?
Yeah, okay. Let me go one by one. So I said in the beginning, right, there are different modes in which money moves from savers to borrowers. There are broadly two ways. One is what we call equity. Equity means I own a stake in your venture. I buy shares in your company and I enjoy both the upside and the downside. So that is fundamental. That is one way in which a saver gives money to a person who needs money. That is equities. In fixed income, I lend you money. I don't invest in you. I lend you money. I don't participate in your upside. But I tell you, I lend you 100 rupees, you give it back to me after so much periods and so much of interest. That is fixed income. Okay. In foreign exchange, it's slightly different. There are different kinds of currencies, right? There is rupee, there is dollar, there is euro, there is pound, there is Chinese renminbi, whatever, so and so. And each of them have their own dynamics, have their own interest rate, have their own rates depending on what the economy is. So, but when I want to move into dollars, then that rate is different. When I want to move into euro, that rate is different. So that is what foreign exchange is all about. So these are three different kinds of market. Foreign exchange is less about moving money from savers to investors. It's more about converting from one kind of currency to another currency.
Ah.
Okay. In equities, you invest. In fixed income, you lend. In foreign exchange, you convert from one currency to another currency. So that's a market. These are the three different markets. So in equity, obviously, when you say equity market, it's the price at which I give you money in the form of equity. Now, obviously, every company is different. So that's why you have the share price of a company, which is the value of the company if you want to invest in that company, right? In fixed income, let's say the government of India borrows money from the public. You don't see it, they actually borrow money every week on a weekly basis because they need to fund their expenses, right? They have various projects, various streams, and all those things. So they need money. They broadly raise money in two ways. One is taxes, and then other is they borrow money and through government bonds. These bonds are usually bought by banks and pension funds and insurance companies. There are a whole lot of them. Retail public like you and me have very little exposure in that market. Now, when they issue bonds, they have to pay interest rate on it. So today they say, okay, I'll pay you whatever 6.5%, 7% for 10 years borrowing. This number is not constant. There's a market which decides at what rate I will lend to the government of India. Today it will be 7, tomorrow it will be 6, day after tomorrow it will be 8. It moves up and down depending on a lot of factors. That is what we call the fixed income markets. Now, just like government of India, you have companies which raise money when they want to invest. When they want to grow, they need money, right? So they also invest. They need to raise money. They issue what are called the bonds or debentures. That has its price. Every company doesn't borrow at the same rate. The same company will borrow at different rates on different dates. So that again has its price. So that is fixed income. Foreign exchange, as we all know, like India may be doing well, US may be doing badly. So the rupee will be stronger. Tomorrow it will be the reverse. Rupee will be weaker. That price keeps moving up and down. So that is foreign exchange markets. Yeah.
So they say strengthening and weakening.
Yeah, that is the foreign exchange market. Yeah. So these are.
So in your role regarding to with regards to balance sheet management, how does it affect your how does those decisions affect your entire bank or institution? What about the risk, the responsibility, and the long term impact?
See, a bank's fundamental role is what? They raise deposits and they lend money. They do a lot of other things, but fundamentally, this is what they do, right? And when they raise deposits, we have various kinds of products. You'll be aware: savings accounts, current account, fixed deposits, and all kinds of other things. Similarly, when I lend to either individuals. I lend in the form of housing loans. It's the most common one. Loan against shares, loan against property, education loan, and various kinds of loan. Then I lend to small businesses, working capital. Then I lend to big companies, trade finance, again working capital, sometimes term finance, various kinds of loans. At any point in time, I don't know in what form I'm going to get deposits. I may get, I don't know how much money I'm going to get. I need to have enough money to lend, first of all. So the fundamental role of the balance sheet management is what we call liquidity management. Make sure the bank has enough money at any point in time to keep lending, because that is our core business. I need to keep lending, growing. That's the way we do it.
And we need to keep getting that money back.
Yes, and we need to do that on a continuous basis. So every day we need to make sure I have enough money. Well, we don't go and raise deposits ourselves. That is done by a whole lot of team, but we coordinate the process to ensure that there is enough money at any point in time. But conversely, too much money is also a problem, because if I raise too much deposits and I can't lend it outside, then I pay interest rate to my depositors. That's a loss for me. So it's not that I can keep raising deposits if I don't have people to lend to. So it's both sides. So we need to. It's more of optimizing that process, making sure I just about have enough to run the business.
There should be a margin where you should be able to get the money and also be able to lend that money.
Absolutely, you got it right. And also, we also try to optimize. We have a small surplus. Make sure we earn on that also. But at the same time, make sure it's available for lending. So we do all those activities.
Surplus
Tomorrow, if I anticipate 100 rupees of loans next week, I need to have it this week, right? I can't go and raise it next week. So I'll have the money for 1 week with me. I need to manage that also. So that's one
make sure
thing.
that we have enough money so that something else.
Yeah, but not at the same time, not too much. I need to anticipate how much money is going out suddenly, because suddenly somebody takes out money, also have a problem. So I need to anticipate all these things and make sure we have enough. This is the availability. Second is at what cost it's available. Okay, I can throw interest rates and get money. Keep offering higher and higher interest rates and get money. But then I should be able to lend at a rate higher than that for me to make money, right? If there are no takers at those rates, then there's no point. So that again, we have to make sure that I get money at a cost at which I can lend and make profit for the bank.
So they are able to, let's say, 7% of interest on your deposit.
Yeah.
You will be charging an interest which is higher, so you will get that money.
Correct. That is what our job is. Now, if there are no borrowers at above 7, and what will I do? It's a loss for the bank. So we need to manage that process. And at a third level, now I'm getting a bit technical. I may raise only 3-month deposits. I may be lending for 1 year to my companies, right? Which means every 3 months I need to keep borrowing to make sure I have money to keep that loan alive. Okay. Now, can I do it infinitely? No. We keep a control on how much we do, because I don't know. If 3 months later I can't borrow, I have a problem, right?
Okay.
So I can't keep doing that for infinite amount. So how much of that kind of game we play? At some point we'll say, no, I won't borrow 3 months. I'll borrow only 1 year now to lend for 1 year. So I'm giving you a very rough feel of that, but broadly this is
broad. Yeah. All right. So what does a good decision look like when you have to take those, as you said, certain outcomes, you have uncertain outcomes. Someone will come and say, I need this much money, you take it out.
See, there are two kinds of, in a trading, first let me go to a trading role. Now, trading role is very interesting. Okay, first let me come to investors. People invest in companies with various horizons. Warren Buffett invests for 10 years. So only after 10 years, you know whether a decision is good or not. But if you're a day trader or whatever, trading fast, Every end of the day, you have a report card. Have you passed or failed? What's your grade for the day? So that's it's almost like being evaluated on a daily basis. It's not like I give you a loan, then you are evaluated only when you pay me. But trading is not like that. You are evaluated continuously. Now a balance sheet is sort of sits between the two because we play again a game over a slightly longish period. I'll take a call. I'll know in 3 months, 6 months time whether the call has gone right or wrong. The way we manage it is we do a lot of scenario analysis. We predict. See, one is we say, okay, this is going to happen, one core scenario, but we have the experience and the humility to know that we are, in
Yes,
all
sir.
likelihood,
Yeah.
will be wrong, or there's a good chance we'll be wrong.
Hmm.
So what you do, you put out various scenarios and then see in every scenario how it's going to look, how are you going to manage, and then you try to manage those scenarios where it's going to be bad for you. You try to protect yourself against those scenarios, cut them out in the beginning itself, and decide on what action you will take if that happens. So that's the way you do it.
So,
So a lot of it is data crunching, simulation, scenario analysis, and do all that.
so looking at your, how do you still manage to keep yourself fit?
So maybe if you go back to my, let's say 15, 20 years back, I was probably not fit. And as usual, I was doing all the wrong things, eating wrong thing, not exercising, not doing anything. And one day I realized that even a 30-minute walk, I was huffing and puffing. So, okay, I thought let's do something. Then I started off by enrolled in a local gym to start off with. So that itself set the started off the journey a little bit. So I started exercising. The biggest change happened in around 2013. So Bombay has this half marathon every year. Okay,
Yeah.
so I was not a runner, but suddenly my wife came and said one of her friends is asking her to run. They said they'll all run together. I said, yeah, why don't you run? She said, no, I'll run if you also run. You also join. I said, okay, I'll join. I just said, fine. So she enrolled and I enrolled, but then I had never run more than 2 kilometers at that time. So I started training. I liked it. So I then slowly I built it up. And then I did my first half marathon in 2014 January. But when you do your first half marathon, you realize that you are really not, you manage, but you're not really fit. There are a lot of issues you have. You have to do a lot more to do it. So then I consulted some people and they told me how to get into a routine of training, strengthening, and for the half for running. So I started doing all that. And after a couple of years, I took one step further. I joined a running club near my house, which is a different ball game because when you're in the company of lots of runners, you get a little bit more competitive. You see them training, you train together, you go on runs together, and so that got me. I still run regularly. I participate in half marathons. That is the training part of it. The other interesting part is my wife is a nutrition consultant, so she ensures that I don't go very overboard. Not even overboard. I stay disciplined in what I eat and how I manage my food habits.
Considering the fact that you need to be there almost all the time, how important is health when it comes to finance or any financial sector job?
It's very, very important for two reasons. One is one reason you said yourself that you will be sitting in one place. But the more important reason is in a finance job, especially in a trading kind of setup, you are always observing the market, moving it up and down, and you're processing the information. So it is mentally a bit stressful, very stressful job in that sense. You're always processing information. So that has a toll on the physical part of your body. So very, very important to stay fit. The best way is to start early. You don't wait till your 40s when things start going bad to get into fitness. You make it a part of your habit right from school days and you'll be good.
Are there any other hobbies apart from running?
Very little time to do anything apart from these two right now. I, of course, try and catch up with a lot of reading nowadays. More of non-fiction over the last few years. I've been reading a lot of history, economics, and these are the kind of books I typically read. But I take my time. I don't read fast. Every book I read a few pages a day, and then that's all I get. I used to quiz a lot earlier. Now I don't have time. I mean,
Quiz a lot?
but it's a very, you have to be in the right circles. And what I found was when I went to some of those quizzing circles, those guys are so hardcore into it that I am nowhere in that league. I don't have the energy or the time to get into those kind of quizzing. Of course, listen to a lot of music. Since I'm in Bombay, I spent a lot of time in the car. Invariably, I play music. So almost 2 hours a day, something is playing in my car.
So you'll anyway have to be statistically found and strategically well made. Planning should be very well done. Okay.
Yeah.
So we get it to the rapid fire now. What is the one skill that matters when it comes to the technical knowledge in markets?
Discipline.
A mistake that young professionals often make in the early days of the career in finance.
Not being humble about market. The markets make you very humble as you go along. You realize you'll never get it right.
One habit that help you stay steady across those market cycles.
I think staying cool, knowing what your downside is and being prepared for it.
A mindset shift that changed how you viewed your role.
I think probably getting the right people with work with you.
Okay. So before we end the interview, before we call it at the end, how are roles in financial markets are changing? How are the roles in financial market are changing?
Okay, first of all, on the trading side, a lot of quantitative trading has taken over the last few years. Okay, people study, build models on how the prices have moved. They see how the price can be modeled with respect to a lot of parameters, and then they decide whether to buy or sell depending on what those models say. You don't sit and decide yourself. You build a model, and then the model tells you what to do. That's one. Second level is the model itself trades. You build a model, and then the model, you link the model to the whatever electronic trading platforms or whatever. And the model itself keeps buying and selling. So there's no person there. The person's job is to develop the model and keep changing and fine tuning. And so at that point, trader has to have the quantitative skills as well as the programming skills, everything to get that going. So what the model is actually trying to do is, see, today when a trader trades, at any point in time he has a view whether to buy or sell, and it's not that he's just coming out of nowhere. He is processing a lot of information around him, and based on that he decides. But it comes automatically to him because he is experienced and it's almost instinctive. He himself probably can't explain it, but that's what he's doing. So when you develop a model, you are effectively trying to recreate the mindset, the thinking of the trader, what he is doing instinctively. You're trying to see whether the model can do at one point. But at the other time, what you're also trying to do is, sometimes the trader can be emotional or arbitrary. So you remove the arbitrariness out of the model, out of the decision making. It relies on the same parameters, but at the same time, it makes sure it's objective and does it. So what these models do is they can actually trade so fast, multiple trades in a minute. So the role now of the trader is very different. He has to be the guy who builds the model, not the person who trades. Now, if you get into an equity, let's say an analyst role, in equity research or something, typical job is you get in, you start building all those, you look at companies, you do analyze, you build Excel models, projections, you study balance sheet, and then beyond that only you progress to becoming an actual investor and decision maker on whether to buy or sell. But the first role nowadays, any program can do for you. You feed in the annual report into any chat GPT or Plot and say, this is how I want my output. It will just give it to you. You can train the model to do the analysis, and then you only have to look at the data. Now, what the concern here is, if nobody is going to do all this in the next few years, but that training is necessary to move to the next step. I have no idea how that's going to happen.